2022 has been a rough year for investors. Stocks no longer go up, diamond hands have been melted, the rocket ship to the moon, it won't even start up these days. Times like this is when I take solace in my income ETF NUSI, NUSI. This fund offers high monthly dividends, protection from volatility, and downside risk mitigation. It also offers capital appreciation with its investments, and there's less risk with interest rates rising. I'm glad that even when the stock market is down, I can live stress-free with my NUSI investment. Man, I'm speaking so many lies, you would have thought I was Jussie Smollett. NUSI has been an absolute disgrace this year. The S&P 500 is down 21%, but NUSI is down 33%. But NUSI doesn't track the S&P 500, it tracks the more volatile NASDAQ 100. So when we look at an ETF like QQQ, they're still doing better than NUSI, down 30% on the year. Now remember, the reason why I'm so shocked that NUSI has such poor performance is that while they do sell at-the-money call options to fund that juicy 10.3% dividend yield, they also buy a protective put to hedge the portfolio and protect against losses when the stock market falls. That's why despite tracking the same index as Global X's Q-Yield has around a 5% higher dividend yield because QYLD, they don't spend the money that they acquire on any sort of crash protection. So now we're left with this. NUSI is supposed to fall less than the stock market, and in exchange, we get less dividend yield. But in reality, not realty, the truth is NUSI falls even more when the stock market is doing bad, and we still get less in dividend yield. NUSI just paid its smallest dividend in history at just 13 cents a share this past month. What is going on here?
I want you to tell me, Kurt, why are my dividends so low? Tell me, Broccoli Man, tell me.
Okay, I think I may have found something. It has to do with NUSI's downside protection. They are buying a put option, which means if a stock declines enough, they actually have the right to sell a security at a predetermined price, which can be beneficial if the stock price is below that predetermined price. This limits the amount of losses an equity can have. If the stock price was to just rise, then the put option would just expire worthless. It's important to note that NUSI is doing the same on the other side of the coin with its caller strategy and selling covered calls. This is where the fund would have to sell to another institution or investor if the stock price goes over the predetermined stock price amount by a certain date. This would limit the upside potential NUSI would get. Typically, these covered calls are done near at the money or just out of the money. The premium that they acquire from this, which is the money the other investor on the other side of the contract is giving us, that's what's actually used out to pay those dividends. But that money also goes toward buying that protective put. The real reason why NUSI has been underperforming is because the stock market has gone down, but it has gone down very slowly. It's been a slow and steady bleed downward rather than an overnight crash like we saw during C19. NUSI's puts can be somewhere in the ballpark of 5 to 10% out of the money around 4 weeks out. So if the stock market keeps going down slowly like it has been doing, these put options will never get utilized correctly and they will expire worthless. Meaning we are wasting our premiums buying puts that are never gonna happen, which means less dividends for us. It should also be noted that the price of puts in downward markets also increases. So the cost to buy these puts, that's increasing, while calls, they tend to decrease. That's where we're making our money. The premiums that we can normally fetch for that, that's going down. Thus, that's another reason why we just saw NUSI post its lowest dividend ever. And this is exactly what Kurt, the fund manager, said in his latest commentary letter.
Dear Kurt, I wrote you, but you still ain't calling. I even left my cell, pager, and home phone number. You must just not have gotten it.
The period that we just experienced is the worst case scenario for NUSI. The slow bleed means the assets the fund holds are losing value, just at a very slow pace, and then the puts are not being optimized. And there's also less premiums coming in via dividends. On the contrary, a slow rise in the stock market would actually be the best case scenario for NUSI, with increased premiums and less stunted growth if their call options expire worthless. With continued rising global conflicts, ridiculous gas prices, interest rate hikes still expected, out of control inflation, supply chain issues, and a severe shortage of workers in our labor force, I would expect to still see the slow bleed continue, which means more bad news for NUSI. I've been pretty disappointed in the fund so far. I know NUSI doesn't control the market, but if I'm paying such a steep price, remember NUSI's expense ratio is 68 basis points. That's $68 for every $10,000 invested. If I'm paying that much, I'd rather have my crash protection actually be useful the few times a decade where it might actually happen. Plus, other high-yielding dividend income ETFs like Q-Yield, R-Yield, X-Yield, they have all been performing better. A $10,000 investment in NUSI since the start of 2021 would now only be worth $7,800 compared to $9,200 for QILD, and X-Yield would have actually given you a positive net return in your money at $10,700. As of now, I'm still holding on to my 100 shares of NUSI, but you can see I'm down pretty big, and even all the dividends they paid me, they're not bailing me out just yet. Alright guys, let me know what you think of NUSI in the comments below. I want to know if the curious case of NUSI is enough for you to sell your position. Now these videos, they do take a lot of time for me to put together, so make sure you're hitting that like button for the algorithm and are subscribed. My videos are always found in podcast form under the Collect Cash podcast name, and I will buy, stash, and collect cash you later.